Okay, good evening, everyone. So let's start the class. It's going to be a very short one. I just want to solve this particular question with you. Then I'll allow you to solve some other ones yourself, which I'll also provide the solution to that as well. So I'm sure you can all hear me clearly. Now, this question says that on 1st July 2017, Pico acquired 30,000 ordinary shares of the 50,000 shares in ESCO. We're now told that the summarized statements of profit or loss and other comprehensive income of both companies at 31st December 2017 are set out below. So it gave us the two statements for PICO and ESCO. We're now told that at the date of acquisition, the fair value of ESCO's assets were equal to their carrying amount, with the exception of building, which had a fair value of 50,000 in excess of its carrying amount. At the date of acquisition, the building had a remaining useful life of 10 years. The building depreciation is charged to administrative expenses, and the building was revalued again at 31st December 2017, and its fair value had increased by an additional 500,000. And I'm told that sales from PICO to ESCO were 3 million during the post-acquisition period. All these goods are still in inventory by ESCO. PICO marks up all sales by 20%. Despite the property revaluation, PICO had concluded that goodwill has been impaired by 250,000. Is the policy to revalue NCR at full fair value? Income and expenses are accrue evenly throughout the year. Prepare consolidated estimate of profit or loss and other comprehensive income. Okay. So from this question, you can see that the year end of the company is 31st December 2017, and we acquired him on 4th July 2017. So this is an acquisition during the year. And we acquired 30,000 of the 50,000 shares in ESCO. I think if we do 30 over 50, that is already over 50%. So
60%.
60%. So ESCO is a subsidiary. Now, before we can proceed to consolidation, let's analyze what these workings are talking about. So at the date of acquisition, which is 1st July 2017, we're told that the fair value of ESCO's assets were equal to their carrying amount, with the exception of building, which had a fair value of 500,000 in excess of its carrying amount. So this is also speaking of fair value adjustments. Fair value adjustments. And I already told you that usually when we acquire a subsidiary, we measure the identifiable assets and liabilities of that subsidiary, which will result into issues like this, where we would find out that the fair value of those assets are higher than their carrying amount. So there would now be a fair value adjustment or a fair value surplus at the date of acquisition. And this fair value surplus at the date of acquisition will be treated as a pre-acquisition reserve to be cancelled out on consolidation. Of course, the other leg is we're going to add it to the building, or the cost of the building. They now say that at that date, at the date of acquisition, the building had a remaining useful life of 10 years, and building depreciation is charged to admin expense. Therefore, this fair value surplus, we will need to then charge depreciation on it because they wouldn't have charged depreciation on it. And but we need to calculate the depreciation for 6 months because we acquired, the date of acquisition is July 2017. So there will be additional depreciation. We also know that the building was revalued again in December. So at the end of the year, they revalued the building again, and its fair value has increased by an additional 50,000, 500,000. That also goes to show that at the end of the year, we had an additional fair value surplus. But in this case now, this gain, this evaluation gain will be a post-acquisition gain that would now be a gain to be shared between the parent and the NCI because this is a post-acquisition gain. You see this 500 evaluation gain at the date of acquisition, and this other one, that's what constituted this 1 million you are seeing here, this gain on property revaluation. And out of this amount, 500 of it will not be consolidated because it will be cancelled out. While the remaining 500, then that one will be available to share between NCI and parent. Because that's this other one. Additionally, we're told that sales from PICO to ESCO were 3 million during the post-acquisition period. They told us that all these goods are still in inventory by ESCO. And I told that PICO marks up all sales by 20%. So there was an intragroup sales of 3 million. And all these goods are still in inventory. And PICO marks up these goods by 20%. So we need to cancel out this 3 million because it's an intragroup sales. And also the unrealized profit on it is because they have marked this up by 20%. So this is at 120%. So we need to calculate the profit. And since all of these goods are still in inventory, that means in the inventory of ESCO, he has the inventory of that 3 million in his inventory. We need to eliminate it. We need to cancel it out. So we'll calculate that and eliminate. And since we are preparing statement of profit or loss, it means therefore that we're going to have to add it to cost of sales. We're told that despite the property revaluation, PICO has concluded that the goodwill has been impaired by 250,000. So goodwill is impaired by 250. And since they are valuing NCI at fair value, that means this impairment would affect both the parent and NCI because NCI too will have a share of the goodwill. You will also have a share of the impairment loss. And that is it. So the only one that requires workings here is the fact that PICO acquired 60%, which is 30/50 shares, 50% equity interest in ESCO. That's the first thing here. Secondly, is that the fair value surplus, the fair value adjustments, at the date of acquisition, which is July 1st, 2017, is a pre-acquisition reserve and will be cancelled out on consolidation. However, we need to determine the additional depreciation. So as follows. So the additional depreciation arising from that fair value surplus of this 500,000, we need to determine it. Since the building has a useful life of 10 years, and we acquired the subsidiary on 4th January 2017, and the year end is 31st December 2017, which is the same year. So we're going to do 500,000 divided by 500,000 divided by 10 years, multiplied by 6/12. Multiplied by 6/12. And what would that give us? If you punch our calculator, what would that give us?
25,000.
That's 25,000. Additionally, the fair value adjustment at the year end, which is 31st December 2017, is a post-acquisition reserve and should be shared between the parents and NCI. So that is going to be shared when we get to that bridge. There was an intragroup sales of 3 million. The intragroup sales of 3 million between PICO and ESCO should be deducted or eliminated from the sales and cost of sales of PICO and ESCO, who sold to PICO sold. Respectively. So deduct from the sales of PICO and also from the cost of sales of ESCO. Additionally, the unrealized profits should be added back to the cost of sales. These unrealized profits is calculated as below. It's 20%, which will be 20 over 120 times 3 million. What would that give us?
500,000.
500,000. And there was an impairment of goodwill of 25. So we need to remember to adjust for this. And that's it. So we have PICO, consolidated statement of profit or loss for the year ended 31st December 2017. Now, what are our sales? Our sales is going to be 21,500 plus 6/12 of this. What does that give us?
28,000.
Minus the unreal intragroup sales.
25,000.
The cost of sales, 14,000 plus 6/12 of this. Six over 12 times 9,000
9,000.
minus 3,000 plus 500.
16,000.
What's our gross profit?
9,000.
Then the next item is dividend received from ESCO to be cancelled out as an intragroup transaction. Then distribution costs, 1,400. What does this give us?
I want 1,200.
Then the next one is admin, 2,000 and 1,100. Don't forget, this is depreciation. They're usually added to admin. You add depreciation and the impairment as well. The impairment of goodwill. Let's add it here too. So what do we have?
3,025 naira. 3025.
Then finance costs, 250 and 150. What was the addition?
325.
Yeah, we can now get our profit before tax. How much is it?
4,451.
Is that correct?
Sure, correct, sir.
Okay. Then what's our income tax? 700 and 450.
So the admin expenses is not correct. It's
That's what I want to
2,850.
2,825. That's what I got.
Okay, 2,805. Okay, thank you. So this is not correct too. So how much is this?
4,650. 4,650.
So what's the income tax?
$925.
What's the profit for the year?
3,725.
Okay. From I can see your hands up.
So the impairment of 250, what about if you put it at the cost of sales? Is it still the same thing?
It's better to put it in admin, except they specifically tell us that it should be cost of sales. It's true. There's no reason why it should be cost of sales. Even though you're going to get the same answer, it's just better. Items like that is better in admin. So, profit attributable to owners of parents and non-controlling interests. So we'll get the non-controlling interest first. Before we get there, we are jumping. We have not done other comprehensive income. There is gain on property revaluation. Remember, out of this 1,000, 500 of it is pre. So only 500 will be consolidated. And even at that, we can only consolidate just half of it since we acquired the subsidiary during the year. So this is 250. At the same time, there was investment in equity instrument of 100. So what was my total comprehensive income?
It's 350, sir.
4,075.
Okay, that's plus this. So let's share these profits between the parent and the NCI. NCI is how many percent? Since parent has 60, that means NCI will have 40. What was the profits of the subsidiary? 19. However, this 19, there has been some adjustments on them. First is additional depreciation that we adjusted after acquisition. So we need to remove it from the subsidiary's profits. because this depreciation was not treated before. Also, these unrealized profits, but in this case, it was PICO that made the profits. So we'll not bother adjusting for this. This will not be adjusted for because it's PICO that made the profit. However, this impairment of 250, since NCI is measured at fair value, that means you will also have a share of this profit. So this 250 will be deducted from the subsidiaries' profit, so that NCI too can have a share of it. And really, that is all adjustments that needs to be made. So before you apply 40%, you need to remove this depreciation and these impairments. So what does it give you now? It's 50.
So how about prorating it? Are we not going to prorate it as well?
Yes, we're going to prorate it. Thank you. 6/12. So you do this, then you prorate
325.
before you apply the 40%.
325.
325. Okay, considering that the total is 3725. So what's the balance?
3,400.
So that's the balancing figure.
Hello, sir.
Yes, Fama.
So, so that means any adjustments made on the that is related to NCI that was done in the parent will be done in this share of profit here.
Exactly. So any adjustment that was made to the subsidiary that would affect the subsidiary's profits must be made here. So like this depreciation now, it was the subsidiary's assets that were depreciated. So it will affect the profit of the subsidiary. Like this impairment of goodwill. Since NCI is measured at fair value, so this impairment would ordinarily, if you remember, we deduct it from subsidiaries' retained earnings. So we will deduct it from here as well. So any adjustment that affects the subsidiary's profits will be deducted from here or added as the case may be, depending on the item anyways. You can go ahead and ask a question. I can see your hand.
I just need to ask for that 250 impairment. Why is it that when we were treating it on the administrative expenses, we added it, but when we are now treating it for this NCI, it was not subtracted?
Okay, good question. So, administrative expenses is an expense. The impairment is an expense. So it's like an increase in expense. That was why we added it because it's an expense. So an impairment is an expense. That was why when we wanted to increase the admin, we added. But here is a profit. This is a profit. We're trying to get the profit of the subsidiary so that NCI can get a share of it. So we are saying there is an impairment loss that will have, which is an expense, which will have definitely reduced the profit of the subsidiary. And that's why that's coming up like that.
Thank you, sir.
Yeah, and I think, again, we are making a mistake here again. We always made that mistake. We cannot prorate this 25 and 250 because they happened after acquisition. So the only one we should prorate is this 6/12. The new one we should prorate is this 6/12. So can you please do this again? It should be 19 times 6/12. Whatever you get.
70. 270.
Okay, this will be 270 now, Abi?
270.
Okay. So what would this be now?
Three 455.
Okay. So total comprehensive income attributable to owners of parents and also non-controlling interests. So we would do NCI will get 40% times what was the total comprehensive income? Now we cannot pick this entire 29 year because because 500 will have been of course cancelled out from this pre. 500 needs to be cancelled out. So that's 29, which is the total comprehensive income, minus take out 500, which is the pre-acquisition retained earnings. Then I say retained earnings, evaluation surplus. You then prorate it before you then deduct all of this again. This 25 and 250. And when I'm deducting it again, is because this 29, this 19 is inside. This total comprehensive income is 19 plus other comprehensive income. So anything you adjust up here, you must adjust it again down here. Right? That's how it works. So let me do this, multiply by 6/12. Then whatever you get, you minus 25 and 250 before you apply 40% on it.
370.
370.
Okay. 370.
Sorry, sir. Can you help me to take that explanation again? Why we have to deduct the impairment again in the
Okay. This 1,900 profit for the year is included in this 29. Don't forget that this 29 is 19 plus other comprehensive income. Okay. Yeah. This 29 you're seeing here, this 19 is inclusive of it. Okay. So any adjustment you have done up here in terms of the consolidation adjustments, you have to also do it here again.
Okay.
Is included. And this 500 is just the pre-acquisition surplus. Then we'll have 3,725. 4,075. This total comprehensive income. 4,075. What was the balance?
3705.
Okay.
That figure is in front of non-controlling interest. So go up a bit. That 370.
Oh, okay. Thank you. Thank you. Okay, and that's the end of this question. So this has exposed you to quite a lot of adjustment that you need to know. So just try to practice it. So you have a question, Chineye? Go ahead, please.
Yes, I do.
So please, I'm just a bit confused with that gain on revaluation surplus, the second 500, because the additional information A says that it was revalued at 31st December 2017. I was thinking because we've acquired it before it was revalued again, we are supposed to take the whole figure and not do a 6/12. So I don't really understand why we still apply the 6/12 to it, sir.
Okay, that's a very logical one and requires us looking at it again. So, where is it? Okay, this one. So since we acquired this subsidiary, okay, this 500 is the one at the date of acquisition, while this other one was revalued at December at 500,000. So it was revalued at the end of the year. So yeah, they told us that it was revalued at the end of the year, and we acquired the subsidiary at July. So for us to be able to test that theory, so let's assume this 13,000 too. We are taking the whole of the 6/12. Does that mean that this whole 13 million was earned in July? Why are we taking the entire 6/12? Are we saying that there won't be some of this 13,000 that was made in December? Or are we saying there's some of them that is not made, that was made in November or through the year? So the fact that we are taking 6/12 is not, it's just to balance it out and not necessarily for that we can accurately determine exactly when these expenses or income were generated. So even though this one, we know that it was generated as at the end of the year, as far as the subsidiary is concerned, but for us, this for him is for the year. This 500 is in his income for that year, whenever he has earned it, in as much as he has earned it after acquisition. So since we came in during the year, whenever he has made those income, whenever he has made those expenses, we take 6/12 of it. So I hope the analogy works with you, Shine.
It's okay, sir.
All right. So irrespective of when any of these expenses were incurred after that 6 months, it could be prior to then, it could be any time during the year and all that, but we still did 6/12 of them, of all of them. So we cannot then take the whole of this. We'll do 6/12 of all his expenses and income for that year, irrespective of when they arise. Okay, so that is it for this question. And so I'm going to stop here. I just wanted to solve this question so that we know that we have concluded this. So I think I'll talk to you guys later when we are in our separate classes, but I'm happy to inform the FR guys that we're officially done with group account. Why the other people will still need like 2 or 3 more classes to finish the 2 other parts of group account for you. We're already making progress as well. But I will share these 2 questions with you for your practice. See if you can prepare P&L with this additional information. Just go through it yourself and try it. Try it. You can share it with me. I would try and share the solution that I solved with you. So let's see what you can come up with this. And yes, this has taken us almost 7 classes or 8 classes for the skills guys. Don't forget that group account is don't spend too much time studying group account. Just try and understand all those basics the way I've taught you. Pay more attention to accounting standards. Go and read those ones so very well. That's where your exams actually comes from. A group account is also an optional question in the exam. And go and pay attention to published. Anyway, when we are in our separate class, we will discuss that. But we will be meeting again. I will let you guys know during the week. But for my SBR student, I'll see you guys on Wednesday to finish up disposal. Okay, let's go and rest. Thank you very much. See you later.
Sir, hello, sir.
Yes,
Sir, hello,
Michael.
sir.
Yes.
Yes, sir. You know, I asked in the morning if you help me share the morning on and probably this, sir, please, so I can run through, sir, please.
Okay, the notes, Abby.
No, the video.
Okay, no problem. We'll share it tonight.
All right. Thank you, sir.
You're welcome. Bye.